good to be with you on this election day afternoon. Markets are treading water at the moment, up slightly. They are off the highs of the day, but we did come down from a pretty significant high last week, but we did find a floor by the end of last week. So could be forming a higher low, which would be pretty notable. Let me go ahead and share my screen here so we can start looking at the S&P 500. As you can see here, here's that fade going into the close. There's some big troubles unfolding in crypto land. FTX reportedly insolvent, Binance trying to buy that out. So, it's leading to a massive liquidation across the crypto complex at the moment, and that's the way margin calls work. Even if a stock or any particular market or asset is in an uptrend, portfolio managers or traders, they have losses in those positions, and they need to sell to raise cash to make up for those margin calls. So it seems to be a margin call unfolding to some extent due to the crushing price action in the crypto space. Let's actually take a look at it pretty quick. Start off by looking at Bitcoin. You can see Bitcoin's down 9% on the day. We've talked about this price target extensively before. If my cursor wants to cooperate here, you can see here we've have this inverted saucer pattern in Bitcoin, and this is projecting prices down into the $10,000 to $12,000 area, which is the price zone that we've been talking about as an area that we might want to be looking to start accumulating long-term positions in cryptocurrencies. But I think the biggest risk that this pullback in crypto creates, let's look at Ethereum real quick, because Ethereum is now down more than Bitcoin, and we've seen a lot of relative strength from Ethereum. You can see how Ethereum is so much higher off its low from June compared to Bitcoin. That's relative strength 101. I think going forward, once the crypto bear market ends, I do think that Ethereum and other decentralized coins are likely to lead the way higher. But we can take a look at Binance Coin real quick, because it was up pretty nicely, and now you can see it's only down 2.5%, but that's quite the shadow in the candlestick. So anyways, back to the S&P. I think the biggest risk here, if you look at equities, is observing the positive correlation between stocks and crypto that's been in effect for basically the last year. And until that correlation breaks, seeing this really sharp sell-off in crypto does raise some concerns. Now, we do know that there have been occurrences in the equity market following election with wide volatility. One example that comes to mind almost immediately is the 2016 election, when stocks crashed in the overnight session, but then basically gapped up the next day and began a torrid bull run to new all-time highs. Now, seeing this fade here on Tuesday, if we get a nasty candlestick down tomorrow, I think we're probably going to be making new lows in the S&P, probably down to the $3,000, $3,200 area. But the big line in the sand for us has been and will continue to be this $3,800, $3,900 area. As long as stocks are above or within this zone, bulls do have a fight against, but the bigger concern is the potential breakdown from this inverted saucer formation. This that formed in October had this nice case of bullish divergence in price in the RSI indicator. So I do think that bulls need to be cautious right now, not really an environment to be pressing the issue all that much. But if we do start to close above that high from last week, above 3,900, then I think that bulls likely will have that impetus. But we've been talking about this $3,800, $3,900 area for quite some time now, and to see prices stall out in that area, I think just vindicates technical analysis. So I do want to take a moment to talk about what's going on in the precious metals here, because some really notable price action. Taking a look at GLD, the gold ETF, up 2.3% on the day. And I think this really is a signal of waning confidence to some extent. That is really the bull case for precious metals, whether it's waning confidence in in the monetary system, or in the geopolitical system, or in governments, or what have you. Precious metals do better when there's higher levels of uncertainty. Well, you could say, well, how about since March of this year, there's been no shortage of uncertainty? Well, that's a fair argument. However, the Fed's been raising rates. You can still get your bonds and your treasury bills redeemed, but this is a pretty significant bottom here. It looks like in gold. It appears that we broke out from a descending price channel, And I think that this could be a major theme going into the end of the year and possibly into the first quarter of 2023. That is precious metals exhibiting some significant outperformance against the broader market. Take a look how we had this, 6-month correction in prices, and we didn't even hit oversold on the RSI indicator. So to me, that says corrected decline instead of the start of a new bear trend. And then we had this nice case of bullish divergence in price in the RSI indicator there too. So, but I do think the greater value within precious metals resides in silver. Silver leading the way now on a percentage basis. You can see it had a case of bullish divergence there too. There's a lot of silver bugs out there, and maybe they'll finally get their day in the sun. I think the biggest catalyst for silver as we look at this SLV ETF is the apparent breakout. One could make a case that this was an inverted head and shoulders pattern. That's what I tend to lean with, or you could say, rounding bottom. We're kind of just playing semantics at that point. But silver looking good, really good, breaking out to its highest level since June. Tremendous relative strength. We're not seeing that type of strength in the stock market. But, when we do look underneath the surface of the stock market, where are we seeing the strength? It continues to emanate from indexes like the Dow. Dow's up 0.5% on the day and just made a new multi-month high, rallied up to its highest level since August. Tech's still lagging. So the strength that we're seeing continues to come from the inflation areas of the market. We can look at the ETFs. Basic materials look pretty good. This is all part of the inflation trade. Industrials up still on the day. This is looking good. We've been talking about the healthcare sector as well. I do think this is the secret sauce, so to speak, for the NASDAQ. Really needs to see healthcare start to outperform. And I do think that the technical groundwork is being laid for that. You can make an argument that this is a rounding bottom, not really the cleanest pattern I've ever seen, but might be a little bit of a stretch, but that's kind of how I see this right now. But health 134 looks very bullish. And obviously the greatest winner of the year continues to be energy, consolidating a little bit from the highs here. But this energy XLE ETF looks very bullish. You can slice this as a rectangle. I do prefer the the saucer formation in this case, but I do think the inflation trade is not dead, that it's alive and well. And if we start to see participation from precious metals, I think the whole commodity theme rally, commodity bent rally is going to continue into the end of the year and into the first quarter of 2023. The billion-dollar question, of course, is how do equity markets react in the face of that persistent strength? Taking a look at the 10-year Treasury yield here, I think it's imperative that we see yields come down a little bit if we're going to see a relief rally continue in stocks. So 10-year yield down almost 2% on the day. If we're forming a secondary lower high here, could see a pullback in yields down to the 3.5, 3.6 area. I think that'd be most welcome. But again, keep in mind that the yield curve is inverted pretty much across the board now. And this probably means that a recession is coming sometime next year. And before we were talking about how the 3-month bill to the 10-year bill never inverted, but it did. And if we see the 10-year yields come down while the Fed keeps the 3-month bill yield around 3.75, 4%, then you have an even deeper inversion, and it means that the likelihood of a recession is even greater. So one bullish catalyst for stocks, I think, and commodities overall is this pullback in the dollar. We had a really strong up day. What was that? On Thursday last week, but then on Friday gapped down after the payrolls numbers came in above expectations. Job market continues to display resiliency at the moment, even though reports continue to pour in that a lot of companies are either going to start layoffs, increasing the pace of layoffs, or freezing hiring. It really doesn't matter right now. The job market is still okay, even though I wouldn't be betting the house on that, so to speak. I think that layoffs are coming, and per the Taylor rule, which the Fed uses to make these type of determinations, a decline in the dollar does seem to indicate that perhaps they might slow the pace of rate hikes at some point. But then how might that change if the inflation trade starts to reignite again? So this is the conundrum that we face as macro analysts. So if job losses start to pick up, how much is the Fed willing to tolerate job losses or slower economic growth to curb inflation. And if that means pausing the rate of rate hikes, the dollar could calm down a little bit. But I just have a hard time believing that the dollar is going to basically start a bear market from its current levels when you have the Japanese yen paying nothing. You have the Eurozone at 75 basis points above zero. So the interest rate differential is too big, I think, at this point. So you best believe that the ECB and the BOJ are calling the Fed every now and then saying, please just pause the rate of rate hikes. So we'll see what happens. Obviously we have the elections today, and elections have consequences, whether it has to do with policy or, whatever. I do think that in order to combat this inflationary conundrum that we face, not just in the United States, but across the board, we need to open the floodgates with respect to supply. The central bankers have been obsessed with demand-oriented economics, basically since the beginning of the 20th century. That's when Keynesianism, that name kind of gets thrown around and misconstrued a little bit. But the obsession with demand side economics, the idea that you can control consumer demand, when really I think that the free market determines that more. And I do love to make jokes about a free market because a free market has never existed. But if you want to mitigate the inflationary crises, you have to go after the supply side of the equation, open the floodgates, pump more oil, produce more grains. Not the best year for agriculture in terms of yield. A lot of the crops suffer from drought and whatnot, and that's reducing supply. And the supply chains are still reeling from the lockdowns of 2020. So we have to keep that in mind. But I do think that a falling dollar probably is going to send commodity prices higher, so we have to be aware of that. Take a look at crude oil, USO here down a little bit as well. But as we run through some of these energy stocks, MRO still looks pretty good. Vermilion Energy, these are stocks that, we've had in the books for quite some time. And we've been a fan of, several biotech names. Neurocrine Bioscience is still up 2% in the day. So there are stocks in bull trends. We have Amgen up over 5% today. Really strong performance. This gap up, and hopefully it can close in the upper half of the day's trading range. But this is a Dow 30 stock. Actually, my favorite stock in the Dow. It's been that for a few weeks now. But the point being is that there's always opportunities out there. You just have to keep managing risk. We've been talking about Turkish stocks too. Turkey keeps making new highs. I don't really care why. I just trade the trend. So that's all the time that I have for today. If you enjoyed this video, I would encourage you to check out my work at www.mmacycles.com. We have several different publications with MMA Cycles, as well as Benzinga, where we publish equity and macro research as well. So thank you for watching, and I will be back same place, but not the same time. So